Now let's get back to the stock market, which, based on the charts, has been fighting the Fed. I know our TSX hasn't exactly been in rally mode, but the S&P 500 is in bull market territory. That is thanks in part to runaway moves in mega-cap tech stocks. That has prompted some previously bearish strategists to reverse course. Of course, I imagine the fear of the bulls today would be a Fed rate hike and a threat to keep those rates higher for the foreseeable future would be something the equity markets would have to consider. Joining us to set the table this morning is Karl Schamotta, Chief Market Strategist at Corpay. Nice to see you.
You as well.
Okay, let's start with what you think the Fed's going to do today.
Right. I think they are going to pause, but the difficulty here is in the language that accompanies the decision, right? So the statement language, the press conference, the updated dot plot. The challenge at this point is that virtually everyone in the markets expects the Fed to set the stage for another hike in July. And that means that they're in a really weird position here. They might have a lot of difficulty in actually out-hawking what markets already expect here. So the question is, if they do acknowledge that sort of slowdown in headline inflation, if they acknowledge that that growth is rolling over a bit, that actually might force rate expectations back a bit and sort of unwind what they're looking to achieve.
Do you think they can be successful on that front?
I don't. Okay. This is an impossible situation for the Fed to be in right now. Fundamentally, they're kind of struggling against a market that is anticipating a situation in which high rates today bring lower rates tomorrow. And so when you're in that type of situation, you wind up with a dynamic where markets go up, economic expectations go up, and demand continues to go up. And so why does demand continue to go up? Because asset prices are rising so quickly, right? So when Canadians and American citizens are thinking about, their stock portfolios, their home values, and things like that, as long as, long-term interest rates remain relatively low and asset prices are going up, they're going to continue to spend. And so the Fed's caught in this position where no matter what it does, it is, even if it raises rates really dramatically in the short term, it's stuck, essentially feeding the underlying causes of inflation. I guess impossible.
The flip side is that everyone is so fearful of inflation, and I know what all the data says today, but it's just so impossible to know where we'll be in 8 months' time.
Right.
And the higher these rates go, you wonder whether you break things.
That's the thing. And, we are clearly at that point where the trade-offs are very severe on both sides. I would say, though, if you look at it very, rationally and coldly, inflation is unquestionably rolling over, right? If you look at your headline prices, if you look at all the things that feed through into services inflation down the road, there's no question that they've all rolled over, right? We know that core inflation is slightly more sticky than central bankers might desire, but that does look like it's rolling over. The unfortunate part, of course, is that central banks cannot respond to that. They cannot, kind of come out and turn on a sort of on a dime and start expressing really dovish views about the outlook. If they did that, we would unwind all those gains and inflation would be back.
Well, that gets us to the story of Canada, which everyone who watches this network knows that the Bank of Canada had been on the sidelines with an official pause. And in that period, home prices started climbing again in this country, and then they surprised the market by stepping off the sidelines to raise rates. Some people thought that surprise decision could influence the Fed to the point of the Fed ultimately staying hawkish today. Why has that narrative not really played out, at least in the eyes of traders?
That's a really great point, because we have seen this happen repeatedly over the last year. When the Bank of Canada, expresses a more hawkish view, then we do see global yields rise, not just in the U.S., but the euro area as well. And
because it indicates that maybe other central banks will do the same thing.
Like we're sort of the canary in the coal mine, as you might put it. But the problem is that Canada is dealing with very, very different dynamics. The U.S. has a very much more diversified, larger economy, and it is dealing with dynamics that are different. And so, to some extent, the Fed's actions really should be reflecting back on what the Bank of Canada is expected to do, not the other way around, right? So, if we do see continued high levels of demand in the U.S., that is going to anchor Canadian rates higher, but we should not be thinking in the obverse terms and thinking that Canada influences the U.S.
And that point that Bloomberg Economics made, that if there's a pause today but a hawkish tilt, and the argument can be that the Fed's been aggressive. Is there a case to be made that they've been more aggressive than Canada? I mean, I feel like rates have gone. Yes.
Yes. Not only because you have that pace of interest rates moving up more rapidly, and that they continue to do so even after the Bank of Canada paused, but also the level of interest rates going in was lower. So this is a much more dramatic move from the Fed, and much more influential in terms of setting the cost of capital for global financial markets, and for setting the cost of capital here in Canada. Right. So much of what the Fed is doing is feeding directly through into what we see in financial conditions here in Canada.